This is Wealth BT, a podcast of BT correspondents.
You've most likely read about the great wealth transfer in Asia. Around $6 trillion in wealth in Asia Pacific is being handed down to younger generations over the next few years. Amidst this massive wealth transfer, more families are adding insurance into their toolkit, besides trusts and other structures. What is it about insurance that makes it suitable for multi-generational wealth planning? If you're thinking about using insurance yourself to structure your wealth, what questions should you ask your bank or advisor? Welcome to Wealth BT Podcast, part of the BT Correspondents family of podcasts. I'm Genevieve Cua, Wealth Editor of the Business Times. With me today is Carlton Crabbe, CEO of Capital for Life, which specializes in life insurance for high net worth clients. That is, in indexed universal life policies. Welcome, Carlton, and thank you for sparing the time.
Thank you for having me, Jen, and it's a pleasure to be with you, of course.
First, to preface everything, your company HQ is in the UK. You have an international client base, including Singapore, but Capital for Life is not licensed as a financial advisor in Singapore. Tell us how you work with advisors here.
So we work with advisors in Singapore and many other countries across the world. We provide them with technical support, underwriting, access to the carriers, and really help them understand how to structure it and how to work with their clients. Because at the end of the day, most bankers and many financial advisors are not necessarily life insurance specialists. So we found that we occupy a niche whereby we can help the high value and ultra high value clients that they have and also just support their whole process with life insurance.
What makes an insurance product a universal life plan, and how does Index Universal Life, or IUL, differ from the plain UL?
Yes, there's lots of different types of insurance policies you can take out, Jen, but IUL came around in the late 70s, 1970s, early 1980s. So it's been around for quite a number of years. You traditionally had universal life, which was linked really to interest rates declared by the insurance company. It's fairly predictable. It obviously still exists today, and it tends to be linked to the insurance company's general account portfolio performance. And then we have this, some would argue, slightly racier version, so index universal life insurance. And that is allowing the client or the life insured to participate in upside in the stock markets. The most popular one by far is the S&P 500, so linking the policy performance to that. Clients just need to remember that they're not actually invested in the S&P 500, but they participate in some of the upside to that. So those are the two differences between UL and IUL. And then the other ones you tend to have are whole of life par, which tends to be used by conservative or ultra conservative investors into life insurance. That has, again, credits and bonuses given by the insurance company. And then, of course, term insurance as well, which is a very different beast. That's for a limited time period and is typically used by people to cover their time as they're accumulating wealth or for a known need.
So how is it that IULs and ULs lend themselves for estate and succession planning?
They lend themselves to succession planning because they're both whole of life. So they are literally designed to last for the whole of somebody's life, and they will pay out upon the passing or death of the life insured, of course. So people view IUL and UL in different ways, and we like to kind of help them think about it in a slightly wider way. So traditionally, insurance is providing a death benefit. It provides a lump of money, a lump of cash. It's creating wealth for the next generation to use. Often in many parts of the world, that's used to pay estate taxes or inheritance tax in countries like France and Germany and the United Kingdom and, of course, America. In Singapore, of course, you don't have any estate tax, so it's used to typically create more wealth for the next generation. So it's a very useful tool, I would say, to create wealth. There's a guaranteed level of return inside it and also potentially higher level of return. But also it can be used for lifetime value as well. So some clients like the idea of accessing the cash value inside this policy. You can access policy loans and you can also do withdrawals for retirement income planning as well.
Most of the IULs, at least the ones that here in Singapore, seem to have similar bells and whistles, like a choice of indexes and, of course, a crediting rate. So what really distinguishes one plan from another?
Yes, I think sometimes providers deliberately make their paperwork quite similar because, of course, they're all competing for the high net worth and ultra high net worth market. So there's lots of duplication. The things that really distinguish how a client or a prospective client should look at this are the insurance company's financial strength rating. There's no question that that's very, very important because if you think about it, the client is going to put in a premium and at some point, maybe 10, 20, 30, 40 years in advance of today, they want that insurance company to be around to be able to pay out that death benefit. So that's very important. You should also look, I think, at the features. So what do you want it to do, Jen? We just talked a moment ago about how most people will use insurance just for the death benefit, and that's fine. And that's a traditional, the most used way. But some clients do like the idea of accessing the lifetime cash value. They like the idea of potentially taking policy loans. We've seen clients as far afield as Australia using that to purchase properties. So they have cash invested in the policy, they take a policy loan and use it for that. And then, of course, the other one, which I mentioned, is withdrawals of the cash value to fund the retirement. This can sit alongside a traditional portfolio from a private bank and do a very nice job of providing additional income as well, often in a very tax-efficient manner.
I'm sure you've looked at the products available in Singapore. What features are typically guaranteed and what is not guaranteed?
Insurers always show a guaranteed and a non-guaranteed column. So this is all to do with policy performance. Typically, looking at these every day, on the left-hand side, you get the guaranteed version. So the insurance companies have to show you what would happen in the worst-case scenario. And I like looking at that column, Jen, because it helps me help the advisors and the clients understand what is the worst-case scenario. If Armageddon took place, how long is this policy going to last? And it varies, of course, by age. But typically, you'll see the policies on a guaranteed basis lasting anywhere between 20 and 30, 35 years, something in that region. Of course, the older you get, the guarantee comes down a little bit. It's a very long time into the future in which the guarantee lasts. And then, if you're looking at these illustrations from the international insurers, on the right-hand side of that illustration, you get a non-guaranteed version. And typically, they use a 25-year back-tested performance of the policy. So if this policy had existed 25 years ago, what would it have done through all of these years? They take that average, and that's what's the number declared on, if you like, on the right-hand side. And of course, that can look quite attractive, and it's typically illustrating at somewhere between 6 to 7%. Some will illustrate a little bit lower, some will illustrate a little bit higher.
When they backtest, do they take the actual index performance to backtest that?
They do. They take the backtested performance of the index that the policy is tracking. So they will do that and go back all those years and then average out that performance. So that's the number that you'll see on those illustrations when your advisor or banker shows it to you.
Still to come, how likely is it that an indexed universal life policy in which you may have paid millions of dollars in premium could lapse and leave you with no death cover?
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
And now, back to Wealth BT, a podcast of BT correspondents.
Welcome back. Carlton, for listeners who may be asked to consider an IUL, what questions should they ask before they make a decision?
The questions they should be asking themselves are, what do I want to do with this policy? Why am I even considering taking it out? And the answers would normally be around, I want to provide some additional wealth for my family through the death benefit, or do I want to use it in some way, shape or form during my lifetime? Once they know the answers to that, so it's just simple financial planning, Jen. It's what do they want to use the policy for? Once the advisor or the private banker understands that, then we can look at the carriers themselves. We need to look at things like the financial strength. And then it comes down to the features of the policy. So can this policy deliver what you want it to do? And that tends to be a very good place where policies start to differentiate and it starts to become much more obvious about which carrier you're going to do. You might start off, particularly in Singapore, you might start off with 5 or 6 different carriers. You've got some fantastic insurers in Singapore to choose from. And then you start narrowing down that selection. You look at the guarantees and non-guarantees in terms of what a client is comfortable with. And underneath an IUL, of course, you then can choose your index. Which index or indices would I like to follow? The S&P 500, as we said, is the most popular, but you can also get some variations on that. You can also get things like the NASDAQ as well, which is arguably racier, but certainly when there's a flaw in the policy of 0% return, then that can be quite attractive to clients as well.
You were earlier talking about the flexibility of such policies, like clients can take out a loan, can withdraw cash from it. Under what circumstances, given all this flexibility, could a policy lapse?
In my experience, when it hasn't been looked after properly. When we see the day one illustration, what we need to see there is, okay, here are the premiums the client's going to pay. Are they going to pay a one-off single premium, which was traditionally how it used to be? Or are they going to multi-pay? Are they going to pay those premiums over a number of years to suit their budget and their schedule? And of course, there's premium financing as well. So that typically would finance the single pays. One of the worst things I see is clients not paying premiums always on time, or perhaps expecting that the policy can do everything for them. The most important thing a client can do is pay the premiums in good order and on time. And also, if they want to, because of the flexibility, they can even pay those premiums early. Because the earlier the premiums are paid, the less cost of insurance there is to cover the insurer. Therefore, more money can be allocated to the growth of the cash value of the policy. So, keeping the policy on track is very important. Monitoring it is also very important. And then what do they want to do with it? You can't have your cake and eat it. You have to break it down. There's no way a policy can have the maximum death benefit and provide you with lifetime policy loans or withdrawals without something given. And so it's really important to model those scenarios with the advisor and the banker if that's a feature that the client wants to use, and just make sure they're really clear on that. Policies can, of course, lapse. It's important to try and make sure they don't, because obviously the clients typically put in hundreds of thousands, if not millions of dollars. It is extreme when they lapse, but the most important thing is to monitor them.
You've touched a bit about premium financings. What are your thoughts on how attractive is this in today's environment?
Yeah, Jen, premium financing used to be very popular with banks, and I think it probably still is very popular in some parts of Asia as well. If we rewind 10, 12 years, interest rates were much, much lower than they are today. And of course, premium financing was very popular because you could get an arbitrage. In other words, the difference between your policy returns, linked to the stock market, and how much interest you were paying was incredibly attractive. My thoughts on premium financing are it's absolutely fine, but we just need to be cautious. So before we decide premium financing is the route, let's compare and contrast. Let's look at what the total cost of that premium financing would be versus the cost of multi-paying a premium straight to the insurance company over a period of time. And then let's look at other features in the premium financing. So how long is the policy loan for? It's typically a 2 or 3 year revolving facility. Let's not forget that if someone passes away, the loan needs to be paid off from the death benefit. So we just need to think about that. We just need to obviously make sure that a client understands the risks they're taking with the premium financing. But it can be used. We are doing some cases at the moment. And one of those cases, Jen, which I think is worth mentioning, is for key man insurance. So we're using some IULs to back the cross-option share agreement with 3 individuals. And that financing will then be taken out by the company to back those policies. So that is, I think, a very good use of that type of structure.
How do you think clients should set their expectations for an IUL? Is it an investment? And where does it fit into one's total portfolio?
It's definitely not an investment, Jen. It is ultimately an insurance policy, and it's designed to pay out a large amount of cash upon someone's passing. So it cannot be considered to be an investment like that. However, of course, it does have investment characteristics. So it can fit into an investment portfolio And because it's got this floor of 0%, so clients are guaranteed to make no stock market losses for the rest of their lives. Because of the zero floor function, it means to say that if you sit it alongside a traditional discretionary fund managed portfolio from a bank, it reduces the overall portfolio's risk by sequence returns. So you're not getting these huge drops. Likewise, you're not getting the huge gains either. Typically the caps are around 10, 11, 12% in that sort of region. So it can very much be a risk reducer, and it can be something that a client could say, okay, I like the idea of investing in that alongside my DFM because I know that's a pretty safe style of investment, even though, of course, it's an insurance policy. And so I can see the cash value. I could use it if I really wanted to, but also I know I'm going to create this additional wealth for my family. So I think it can sit alongside primarily as the death benefit creation, secondly, to reduce an overall client's portfolio risk.
Thank you, Carlton, for sharing your insights.
Thanks very much indeed, Jen. It's an absolute pleasure.
IULs can play a role in wealth planning, but because it is a big financial commitment, it becomes even more important that you understand how it fits in with your needs and that you set the right expectations. IULs do give you market exposure, but you also give up some upside, and you need to take pains to be familiar with the fees, which can be complex. That's it for Wealth BT this week. BT Correspondents will be back next week with an episode on transport. This episode was produced by Howie Lim and Chai Pei Chia, together with our editor Claressa Monteiro, and was written and presented by me. I'm Genevieve Cua. Thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.